Hello and welcome. I'm Hyder Aboobakar, Business Development Director at IQEQ Mauritius. And it's a pleasure for me to be moderating this session today in collaboration with Africa Global Funds. Today, we'll be looking at ESG and considerations for private equity funds. There's no doubt that changes in the international regulatory landscape, the COVID-19 pandemic, have accelerated investors' interest in sustainable investments, while also increasing pressure on organizations to provide more transparency around their ESG reporting. So having the right ESG framework in place has therefore become a top priority for alternative asset managers, corporates, and private investors alike. Overall, a broad range of factors, including investor demands, are leading more capital to flow towards companies that are better equipped in terms of ESG factors. Governments worldwide are also providing incentives towards ESG-focused activities, implying that more companies are expected to either move in this direction or emerge in this space. Also, regulations are being changed to include ESG criteria, with the most recent one being the EU's SFDR, that is Sustainable Finance Disclosure Regulation. Well, we are certainly seeing a number of tools emerging on the market as well, tools to help GPs with their investment decision regarding ESG. At IQEQ, for example, we have recently developed a cutting-edge investor solution called IQEQ Compass. It incorporates a full suite of ESG services and is supported by powerful technology dashboard that enables managers and investors to navigate, to monitor, to benchmark their ESG KPIs against leading ESG frameworks such as the World Economic Forum metrics. Well, that's just one example of the shape of things to come. Now, let me give you a little bit about the webinar flow. Well, in terms of that, the session will take the form of a debate where both myself as the moderator and you as a member of the audience can pose questions to our experts. The webinar will last for an hour. If you have questions, please do not hesitate to type it in the question box. I think that's on your right, and I'll be very happy to raise it with the panelists. So guys, we're going to have some really interesting insights today on the importance of ESG and its impact on GPs. So I'll try and cover stuff like how ESG frameworks are being applied in private markets, which pillars of ESG are becoming increasingly important to investors, how ESG elements can be integrated in the decision-making process, how ESG performance speaks to revenue, how they speak to costs, and also what are the different elements of ESG reporting. Well, on this note, I'm honored to be joined by our experts today to examine the impact of ESG. We have Tamar Pashtan, Head of ESG and Impact at Vital Capital, Nicolas Piquito, CEO, African Alliance Asset Management, Graham Sinclair, ESG Architect at SinCo, and Paul Boynton, Joint CEO, All Mutual Alternative Investments. I shall now turn to our speakers for a quick round of introductions, starting with Tamar Pashtan. Tamar, if you could please tell the audience a little bit about yourself. Thanks.
Fantastic. Thank you so much, Hyder, and thank you all for hosting this fantastic event. We're really looking forward to participating in. So, as Hyder mentioned, my name is Tamar Pashtan. I'm managing ESG and Impact at Vital Capital Fund. I'll tell you in a few words about Vital Capital. So we were founded in 2011. Vital Capital is a leading impact investor that is focused in sub-Saharan Africa. And our investments are guided by the conviction that creating positive, sustainable impact goes hand in hand with delivering market rate risk-adjusted returns to investors. And that is truly our mission. Our mission is to improve the personal, economic, and social well-being of low to middle income communities in sub-Saharan Africa. We're focused on the fastest growing sectors in sub-Saharan sustainable infrastructure and education. And today we are currently managing the $350 million Vital Capital Impact Fund, as well as our recently launched our Vital Impact Relief Facility, which was launched to support SMEs to overcome the COVID pandemic. So that's a little bit about who we are.
Thanks a lot, Tamar.
Great.
Yeah, thank you. Nicholas, may I ask you to to tell the audience a little bit about yourself?
Yeah, sure, Hyder. Thank you very much for the introduction and for the hosting of this webinar. Nicholas Piquito, CEO of African Alliance Asset Management. We have been managing assets across the sub-Saharan Africa space for the past 25 years. We've got about $1.5 billion under management across asset classes. Essentially, we've been operating within what I would refer to as a ESG type of framework over the past 25 years, just before it had a name, right? And so a large part of what we do is embedded within that. We're also in the process of launching Thrive Africa, which is an impact and ESG type of platform. And we see a lot of opportunity and are very excited in this space, particularly in the private capital space going forward. So fundamentally, that's what we do, and it's really good to be on this webinar. Hopefully, we get some good insights. Thanks, Hyder.
Thanks, Nicholas. Looking forward to it, actually. I'll now ask Graham to give the audience a little background on himself. Graham, up to you.
Thank you. Thank you very much to the Africa Global Funds team for hosting this webinar. My name is Graham Sinclair. I'm at ESG Architect. I've been running my own shop since 2006. We're working with investors in the investment ecosystem, helping integrate ESG into strategies and portfolios. On this topic, my most significant work was 2 years of my life working with a team at Rescura, writing up the IFC's Sustainability in Sub-Saharan Africa report, where we interviewed 145 investors and stakeholders, 37 private equity GPs and LPs, basically every fund in Africa, based on their 2010 data, figuring out what they're doing less well. And then in 2014, I went on to do a project at the African Development Bank, where they asked me to look through all 32 of their funds, 27 were active at the time, from initiation in the late 90s through 2013 financial year, where we had a deep dive onto the development impacts of the various private equity funds that they were invested in, and if they were getting the ESG outcomes that they were expecting. I just really think it's great that we're hosting this webinar today, because I think more people need to know what's happening in Africa and how to get more capital on the ground to grow the real economy. I know the people back home in Southern Africa are really hurting economy-wise now, and I'm just acknowledging my privilege here that we're all healthy, and wishing everyone well in this tough time.
Graham, definitely. Just so everybody knows, Graham is sitting in the US, so it's quite early there. So thank you. Last but not least, Paul, can you please tell us a bit about yourself?
Hi, Hyder. Thanks for the introduction, and thanks to Africa Global Funds and to all the participants. I see people are still streaming in, so it's great to see a good audience there. I'm based in Cape Town with Old Mutual Alternative Investments. We invest the group's unlisted assets broadly. We have 5 different verticals. We're invested in Pan-African infrastructure. We are invested in private equity in Southern Africa. We also have a hybrid equity team doing sort of mezzanine debt, also in Southern Africa. We have an impact team, which is invested in a number of spaces where we are pursuing both a financial return objective as well as a social objective. And the examples of that include affordable housing, affordable schooling, and retirement accommodation. And then lastly, we also are invested in a Pan-African agriculture manager who's managing farming agriculture assets from farming through to wholesale distribution. Thanks, Hyder.
Thanks, Paul. Thanks a lot. Well, everyone, now that introductions are made, let's get down to business. Well, the first thing I wanted to raise with the experts here is the importance of ESG. Well, my first set of questions would be more towards that. Tamar, I would like to send the first question your way. What is the importance of ESG, and how do you see its impact on GPs?
Great, thanks, Hyder. I mean, today we're seeing tremendous investor demand for ESG. In public equities in the last year, it's interesting that an amazing 220 European funds changed their strategy or investment profile to ESG, while another 505 funds, ESG funds, were launched. And in our experience in private markets, the appetite for de-risking and value addition has already become mainstream. So at Vital Capital, to us, being a responsible investor is a precondition for being an impact investor. And we do differentiate these practices. They're related but not necessarily correlated approaches. With responsible investment theories and practices focusing on decoupling negative social and environmental externalities from financial returns, our impact investment strategy aspires to recouple the social impact and turn it into an essential positive part of the investment paradigm. So, in other words, we should implement a do-good principle instead of a do-no-harm one. And in layman's terms, how we see it is impact is what gets me out of bed in the morning, and ESG is what keeps me up at night. So we are constantly striving to bring ESG value addition and value creation into all of our practices. And we're seeing that this is something that we've been doing since we were founded, and it's really becoming mainstream across the board, for GPs and also coming from LP demand.
Well, definitely. Nicolas, you come from the GP side as well. What are your views?
Yeah, I mean, I agree with everything Tamara said. I mean, it's, and I think you would go some way to find anyone that disagrees. I don't think we can divorce the question from the global environment that we find ourselves in. So economically, I mean, we're in a world which is essentially flooded with free money. You have situations where essentially you pay Mrs. Merkel and her friends for the privilege of lending them money. So so I think there's multiple components here. There's clearly a yield-driven component, but ultimately there is a very strong societal move towards doing good, in inverted commas. And rightly so. I don't think anyone would push back against that. So clearly the demand is there, and clearly GPs need, that. I mean, what we have found is that essentially we have two sides to the same coin. So certainly on the investor side, we have found the need for education quite specifically, and also in terms of on the investee side, we have found that operationally there are some challenges, I think, at the GP level. So really, to sum that up, there's no doubt that the world is looking to do good. By world, let's qualify that and say large-scale institutional investors, but ultimately they are driving individual money flows. We've just got to be careful, though. In the financial services industry, we are very good often at taking a theme and running with it, and that's fine, but we need to make sure that this is sustainable, no pun intended, and make sure that as GPs that we can tick the right boxes and make sure that investor capital is deployed appropriately. And so, and we may talk about this a little bit later on, but operationally, I think there are some challenges. Certainly, we have found some challenges in our markets, not only in terms of reporting, but also in terms of education and in terms of how we assess and deploy capital. But fundamentally, the opportunity, massively exciting. The world essentially is coming to us. And Africa, I think, is uniquely placed in this context.
Very, very true, Nicholas. I think, and especially I think the continent, on the E side, there's a lot for us to look into as well. Well, not to degrade the S&G side as well. Well, moving on, Paul, from your experience, what are the major issues GPs are focused on, and how would ESG frameworks being applied in private markets?
Thanks, Hyder. Look, I'll share a bit our experience, but I think it is quite sort of resonant with most GPs. I think that certainly we've anchored our practice on the 17 UN SDGs, and I think a majority or slightly over 50% of GPs have tended to do the same globally. Of the 17 goals, we've selected 12 where we feel, in terms of the type of investment we're making, we will be most able to leverage an outcome. So we haven't focused on the 5 where we think we are less able to do things, not that they're unimportant, but just that the nature of our investment is not well suited to that. And we measure 90 different variables across each portfolio company to the extent they're appropriate. Obviously, not all 90 will be appropriate in respect of each portfolio company. And, you know, so we measure those variables over time, and we can compare, you know, longitudinal progression over time, as well as comparing, you know, one company or portfolio asset to another. Within that, we've chosen to focus on 4 specific spaces as well. So, and what we've chosen there is diversity. So we have a focus on gender equality, and also a sort of South African focus on transformation, which is dealing with historical inequalities, I think, in the South African context, and trying to put capital behind businesses that will benefit historically disadvantaged people. So that's the first sort of focus for us, is diversity. Second, we're focused on we're focused on climate. So we have a huge part of our portfolio is invested in renewable assets, and we are measuring carbon footprint across the full spectrum of our assets in the private equity space, in agri as well. And then lastly, you know, employment. So, you know, decent work, a big focus of us, or sort of 3 areas that we focus on is are we creating employment opportunities, and particularly in South Africa, and to extend across Africa, employment is a critically difficult issue. So that's how we've come at it, Hyder. Back to you.
Thanks, Paul. That's fascinating. I think it gives an idea as to how, well, from an experience perspective. Graham, you have been in the business for years as well, and you will have a different perspective. But for you, what have been the major issues that GPs are focused on? And same question is how ESG frameworks are being applied in private markets.
Thanks, Hyder. My first response is, you know, GPs at any level are looking to raise funds and then deploy that capital over time, manage the portfolio 10, 12, 13 years, maybe at the long end. Fundamentally, they're thinking about where they're going to gather those assets from. So that's what was pretty fundamental and counterintuitive about the finding that we picked up in the 2011 IFC report, was 50 cents in every dollar deployed in private equity in Africa had explicit ESG factors, and the other 50 cents of the dollar had them implicit in some way. That's simply because so much of the money originally came from DFIs, and then you've subsequently found since then some of the positive tailwinds that CRISA, the Code for Responsible Investment in South Africa, or the growing network of the Principles for Responsible Investment, for example, or what the African Venture Capital Association has done in promoting ESG and responsible investment on the continent, what those tailwinds have looked to attract even better efforts on ESG frameworks. There's a caveat here, though, in as much as what is in the DNA, what is at the heart of the investment committee, what is the investment philosophy of the private equity shop. So pretty much it's almost like the quality factor that any fundamental analyst and any assessment of investors will look to determine. What is the quality? You can look at all the numbers all day. You can have excellent reporting. You can have auditors' reports. We know, you know, nowadays those always come with an asterisk. Of the Steinhoff disaster is just the latest example of that. So what is in the DNA of these GPs and the way they run funds? Do they say one thing to one group of LPs and a different thing to another group of LPs? Are the conversations in Nairobi or Lagos the same as the ones that they have in Houston or Geneva? So fundamentally, there's a caution here, and this gets to the, if I would argue, to the heart of the matter around how far can frameworks take you. They can kind of check boxes for you. So if you talk about carbon footprint, that's great. But I'm more impressed by work, say, by the CDC as an LP funding their own Catalyst fund, where they're looking to do things with microgrids. They're looking to be the risk capital on the sharp edge of developing grids that are off-grid, that are looking at transmission in places where other people aren't deploying money. So it's not just about the frameworks. You can look really good on paper, but it's getting to discern the quality and the investment philosophy of that shop, not just in boardrooms, but what they say after hours as well. Back to you, Hyder.
I think we may have lost Hyder.
Yeah, I wonder. Well, I think we have lost Hyder, but I know that one of the things that you wanted to chat about was essentially touching on demand for ESG policies, investor demand, and also what was top of investors' agenda. So I wonder if I should maybe just kick off some thoughts on that, and then what might be useful to get some input from yourself, from your perspective. I mean, I think just to touch on it, Paul, the point you just made, I thought was really, really interesting. You used the word caution, right? And I think that encapsulates, from in our experience at least, I think that encapsulates this quite nicely. So, is there investor demand for ESG? Absolutely, undoubtedly. There's no doubt about that, right? And certainly, if one were to go purely by media reports, there would appear to be a proverbial flood of money, which of course is not necessarily a good thing, right? So is there demand? Absolutely. But I think the point about caution is very, very relevant. So, off the top of my head, I think there's 3 or 4 factors that we've picked up, recurring themes, right, in terms of the investors and in terms of what we see. The one is this notion of, colloquially, to coin a phrase, greenwashing, right? I mean, it's a verb which didn't even exist, I would have said, 12 to 18 months ago, right? And now, now we've got the EU coming out with regulations to avoid that, and that's a natural occurrence, right? I mean,
sorry guys, that's the issues
problem.
of being. We are in lockdown in Mauritius, and as you can see, sometimes connection can be
it's a small price to pay, Hyder, for being able to live in paradise.
So, Hyder, maybe just to ring you, we were aware that you were looking, that you wanted to touch on the subject of investor demand, certainly from LPs for ESG, as well as some of the agenda items that would typically touch investors. So I suggested maybe I'll just grab that, and then perhaps Paul could just follow up.
Oh, that's very kind of you. Thanks, Nicholas.
Yeah.
My question, I wanted to touch base on investors. So you're talking about investors. That's because that's very important. Right. We were on the piece of how GPs look at things. So I also wanted to cover as to how those GPs attract funds, because at the end of the day, we are managing funds for the LPs. Up to you, my friend.
Yeah, no, correct. So I was just touching on the point that Paul used the word caution. And I think, so is there demand? Absolutely, undoubtedly, right? There's no doubt about that. I think there are 3 or 4 things that investors look at. This notion of greenwashing, I think, call it greenwashing, give it whatever name you want, I think is important. I mean, we know the financial services industry is notorious for latching on a theme, right? And all of a sudden, everybody is an ESG manager. So I think that is front and center in investors' concerns. I think also that most investors do wish, certainly on the LP side, do wish to be seen to be doing good, and absolutely fair enough. So there's no doubt about that, and that ties nicely in with the ESG concept. But I don't think we should forget, and certainly which has come through for us in terms of the discussions we've had, the need for return and the need for real return and the financial component thereof, I don't think should be dismissed. Everybody does want to do good. we all want to do good, but also these investors are fiduciary stewards of other people's money, and they need to generate a return in a world which, quite frankly, is desperate for return, right? In the age of underfunded pension liabilities, for example. So I think that for us has also been front and center. And then finally, issues of durability, right? So as a GP, do you have the scale? Do you have the team? Do you have the durable processes? A lot of the points that Paul touched on earlier. So, off the top of my head, those are the 3 or 4 things we see. Is there demand? Absolutely. Is there interest? Absolutely. I don't think it's as easy as people may think. I think there are some real practicalities that need to be touched on here. But, therein is the opportunity for serious players.
Great. That's very insightful. Thanks, Nicholas. Paul, you're also on the GP side. What has been your experience? And maybe, like Nicholas was mentioning, yes, demand is there, but does the demand overweight the need for financial returns? So I would be glad to hear your views.
Yeah, I think demand is definitely there, and I think it's a conversation between GPs and LPs, and certainly the conversation that we've tried to engage with is there's definitely an interest and a demand for information and understanding what's going on. But what we've tried to frame is that you need to have a holistic assessment of what's going on. So it's all very well to sort of go out and say, look, we've done this wonderful wind farm and this is all environmentally friendly and this is what we've done here on job creation, whatever, which is all anecdotal. But actually what we think investors need to be able to do is to say, what has happened across our fund? What is the carbon footprint across our fund? What has been job creation across our fund? What have you as a manager done across the whole cohort of funds? And we'd also like to compare you to other sort of competitors out there. If you're invested in a glass manufacturing business, what is their carbon footprint compared to competitors, kind of thing. So a very important part of this, we believe, is establishing the measurement plumbing to be able to measure these things and then articulate them in this holistic sense that investors can understand and evaluate what you're doing and how you're contributing. Maybe just a little bit to just tease out the E, the S, and the G. I think governance has always been a focus for any investor historically. And I mean, it continues to be, and certainly one of the arguments we put out to portfolio companies where we're, negotiating to acquire an interest is that we can help, improving governance standards within a small, family-owned business that's, looking to grow bigger and potentially go onto the listed market. And so that's a value add that we can bring into a process, establishing appropriate committees, establishing governance framework within the business that may historically have been, a light touch on the government edge. But it continues to be a very important principle. More recently, we've seen social issues, particularly with something like COVID, come to the fore in terms of, what is the framework around employees at work? What is the framework around customers of the business? How we, from a social point of view, are appropriate protections in place? Worker conditions and worker rights. And particularly in our infrastructure business, where we're doing development, greenfield development in different parts of Africa, this focus on community involvement, and is the community comfortable and appraised and knowledgeable and on board with what's being planned, and getting that community piece right, I think is so important. Just the last bit of your question, Hyder, which is the trade-off between return and ESG. Certainly, we believe that ESG adds value from an investment return point of view, properly implemented across portfolio companies. So, we think it's an accretive activity rather than a cost-driven issue. But having said that, our impact funds, so-called impact funds that we have launched on the premise that we aim to deliver investors a return commensurate with the risk they're taking, but the liquidity in some of these investments is much more, they're much more illiquid than a similar level of risk investment might be for that return. So people are investing in affordable housing. There's a 2 million unit deficit in the affordable housing space in South Africa. And the thesis we put to investors in that fund is, you know what, you're going to get a return commensurate with the risk that we're taking on putting this affordable housing in place, but you're in for 15 years because it's a long investment cycle and it's illiquid for a long period of time. And you're probably, well, you're not being compensated adequately for that illiquidity. But so we have framed that as a trade-off. And similarly with our affordable schooling fund, which is the same issue, you know, we're establishing schooling infrastructure. It's not quite as long as 15 years, the tenor on that fund, but nevertheless, your capital is tied up for quite a long period of time.
Yeah.
Thanks, Hyder.
Thanks, Paul. Okay, so we've looked at the demand for ESG in general. We've looked at how GPs are looking at it, how the LPs are probably in terms of demand. But then the question that comes is, I'm a fund manager. I need to generally when I'm looking at an investment, I'm looking at the financial returns. So question, maybe I will address it to you, Graham, is how do we integrate the ESG element in the process? And what are the challenges that you know the GP will face? And is this something like in normal financial returns, it's quite straightforward, or I would say straightforward, where you have you know how you're doing it, but in this case it's so vague. What are your views?
Question. So let me begin fundamentally and philosophically. We live on one planet Earth, right? Elon's trying to get us to Mars. I'm not going, maybe my daughter will. Like, I'm not, right? We've got one habitable planet in this many galaxy of galaxies. So every investment on planet Earth that involves humans who need to make, do, or buy stuff, and where you need the rule of law to protect the governance of the business systems, and of course, minority investors' rights. Every investment has ESG factors. So one thing I'd like to close the gap on this webinar and forevermore with people is there's ESG everywhere, implicit in every investment decision. So once we understand that correctly, then we can reflect on, well, how do we maximize the positive and minimize the negative? Which also helps us deal with this industrial scale greenwashing. I know Nicholas referenced greenwashing. It's even worse than that. It's literally, it's industrial. It has been scaled up and there's just floods and floods of it. I can't wait for it to go. Eventually, it'll subside. Where do we start on how to change the investment decision-making process? Well, we start with the philosophy where I began. In my first answer, I dealt with the issue of culture. What's really there between the lines that's not written down on paper? Cultures eat strategy for breakfast, as your favorite management consultant would tell you. So what's the culture of the humans who gathered in that investment committee, supplemented by data sources and algorithms and what have you? What's the culture of that decision-making and the relationship between that fund and the portfolio companies that they will effectively build quite a long-term relationship, yeah? Longer than the average CEO tenure, which is around 5 years. If you're into 10 to 12 years, perhaps on the long end, that's a fairly long relationship that you're going to be having with that portfolio company. Thirdly, there's the issue of how do you integrate which environmental social governance factors you've determined to be material to this particular geography or sector or stage of the business life cycle that this particular portfolio company is engaged in. Because those will differ or shift over time. And so you need that suppleness to move across those and change those weights or those areas of focus. And a quick sidebar on that note, COVID has scrambled so many things. The economies in Africa are under tremendous stress right now. So an issue that's way more important to a portfolio company today is simple things like liquidity, like having the availability of a GP with the fund, working with the GP and the LP, that they're focusing really hard on trade financing or really hard to Paul's point on what is happening to the employees day to day. You know, what is the situation like around the sites of the different operation and so on. And let me end with some of the challenge. Some of the greatest challenge we have is the blah, blah, blah. And I hope today's webinar is going to be informative. It is educational. But remember, the Turnberg said at Davos earlier this year, she's tired of the blah, blah, blah. That is the most fantastic, shortest, most effective speech I've heard in a long time, because it helps me remind myself, maybe it's you too, in the conversations that do it, that we cut through the blah, blah, blah and get to where's the money actually going? How's the money coming back? What is the value of those exits? Are they moving faster? Yeah. Positive ESG factors that help the deals happen at better valuation, whether strategic buyers or are opening up more doors to listings on the preferred exchanges.
Thanks, definitely, Graham. Thank you. Tamar, anything you would like to add on this?
Of course. I mean, as Graham said, ESG is implicit in every investment decision. And that is really the precedent of how we design our investment decision-making processes. So to share just a little bit of insights on how we integrate that, Vital Capital uses a dual gatekeeper model, and we weigh financial and impact considerations equally when evaluating potential investments, and we will only pursue opportunities with sufficient potential for both. We recently emphasized this investment process with the addition of an impact committee that congregates alongside the investment committee, and therefore we have much more detailed and rigorous discussions around ESG issues. So I would add that in terms of impact management and measurement, our approach is comprehensive, and we are doing this throughout the entire investment process. And first, we are looking at gating factors. And as a gating factor for even considering an investment, we are evaluating the ESG status of an investee in relation to the IFC performance standards. So based on the ESG due diligence, we will share our investment decision with our IC and negotiate ESG terms in the investment agreement, later through monitoring and through exit. And then you asked about the challenges, which is, to an ESG practitioner, it's plainly in newfounded issues that arise following investment. So, we can do ESG due diligence, and then we know how to create corrective actions and to make sure that an investment has a very low ESG risk profile. But new issues continue to evolve, and the way that we really opportunize on this challenge is to foster open and trusted relationships with our investees. And that is the way that we really see that is key to building value in companies. It encourages fruitful discussions and enables us to benefit from it. It enables investees to benefit from the fund's experience and vice versa.
Well, that's actually very, very, very interesting. So it helps the investee companies both ways. Well, on that note, Paul, I would like to get your views. I know we've touched on the return versus related to revenue and cost. Paul, can you hear me?
Yes. Hi, Hyder. Yes, I think I caught the question. It was financial return and revenue and costs and how they impact ESG. And I think you're right. I think, historically, a lot of ESG has been focused on risk mitigation, not on framing the upside. And to a point that, Graham made earlier, what's required here is not tick a box, but it's like thoughtful consideration of what your footprint is, what the issues are, and what, the impact of your investment is, just broadly speaking. So historically, we've seen, ESG would be focused on things like, looking at the community and community relations and the risk in that, looking at health and safety within a business and the risks of those things going wrong. And that's all appropriate and correct. But, what's more exciting in this space is looking at, if we analyze a company's waste stream, for instance, are there different things we might be able to do with a waste stream that are accretive for the business, not about mitigating environmental risk with a waste stream, but actually repurposing some of that waste stream into a better outcome, which is, I think, talking to Graham's point, which I think he was making, which is this holistic assessment. If you can holistically consider what's going on, is there a better way of doing something such that we get a better outcome? And you're seeing this now with, guys like, Nestle coming out with their coffee pods, where they've repurposed their coffee pods. There was a huge environmental negative impact from what they were doing with those coffee pods, and they've repurposed it now and try to make it into a virtuous circle. I mean, there's obviously still some degradation happening there, but I think business is doing that, and that's on a global scale. They've mobilized around that kind of issue. Apple's trying to do it a little bit with its product, to try and repurpose it, get it brought back into the system so that the waste streams are minimized. So I think that is where we should be trying to focus increasingly forward, Hyder, which is the upside opportunity on getting some of this thing right, rather than just the risk mitigation piece that has been the historic focus.
So it's good to note that there's also the upside opportunity, not just a risk mitigating aspect from an ESG perspective. That's very well noted. Guys, I'm conscious of time. There's 20 minutes left, and I also wanted to take from the audience. But before I go there, I have a last question which I would like to pop. I would ask Nicholas. That's more in terms of the reporting side of ESG for funds. So what, according to you, what are the different elements of ESG reporting? Is it that are smaller managers behind the curve on ESG, or is it down to reporting and processes? Nicholas, I'd like to know to get your views there.
Yeah, thanks, Hyder. A great question. I mean, I'll keep it brief given the time constraints. I mean, I guess fundamentally the question needs to be framed in terms of the granularity of the reporting. So there's absolutely no doubt that one can report data at an extremely micro level. In our experience, certainly to date, and given the level where a lot of LPs sit, there's far more focus on the macro. So really, I think I'd say there's three things that pop immediately to mind. One is in terms of the reporting, questions about sustainability, which I've touched on earlier. In other words, in terms of what we're seeing, is this sustainable? Can we continue, or is this flash in the pan, to use a colloquialism? Secondly, trend. So, again, certainly for us, you can put a lot of micro data on the table, but we have a lot of questions about trend. Like in other words, in our experience, a lot of LPs are saying, are we going in the right direction? In other words, it's more about where you're going as opposed to the quantity at this point in time. And then thirdly, and I think this has been touched on, and this all ties into this whole notion of greenwashing and the flood of essentially, let's just say, providers that Graham has referred to, is one of verification, and in particular, independent verification. So we certainly, in our dealings with LPs, have detected, rightfully so, a natural skepticism, right, in terms of reporting. And again, I say rightfully so. And certainly we've taken the internal decision to partner with independent partners on the verification of ESG and governance and impact outcomes. So to my mind, those are the three primary areas in terms of high level of reporting. The last point to touch on, are smaller managers at a disadvantage, or at least, are they behind the curve, to use your question? I don't believe so. It's not. I do think that this is a case where size is not necessarily your friend. I think LPs need to be very, very careful here. Size often means a more impressive marketing machine, right? So I think we've got to be careful. The operational complexities clearly are something that one needs to look at. So yes, I think it's a question of process and complexities. Does that mean that smaller managers are de facto behind the curve? I don't believe so.
Well, thank you. Tamar, what are your views? Do you agree, or do you have any conflicting views?
I agree full-heartedly. I'll add. Mm-hmm. I'll add very briefly that,
Sure.
Vital Capital, we're active managers and we see controlling stakes in our investments. So we engage regularly with our investees, and we have regular meetings with our company management, and we have a dedicated team internally. So by conducting periodic monitoring reports, we'll get some good insights on the ESG, but any practitioner will be able to tell you that ESG reporting is just a small role in a bigger function of being out in the field, conducting site visits, spending time with investees, and truly understanding the opportunities for ESG value creation in companies. To us, we understand that this is where ESG can help to achieve above market rate returns. So we capitalize on our team's experience in multiple cycles and really try to drive that. On the point on smaller managers, I totally agree with Nicholas. There shouldn't be a reason that they are behind the curve on ESG just because they're smaller. Is not necessarily correlated to size. But I would say to funds to look for strategic co-investors that are aligned with their ESG requirements in conducting their investments, so that they can continue to prioritize ESG and have other LPs in their investees that are looking for similar such requirements, and it spreads across the engagement with your investees.
Well, thanks, Tamar. Well, thank you. I'll try and pick up some questions from the audience, and just bear with me a sec. So, and I might not be in order, audience, so please forgive me for that because I'm just scrolling there. There's one question. Maybe I'll push that to you, Graham. Is there an estimate for the ratio of ESG over global investments? Why is it still so low? Well, interesting question. So I think you're on mute. Graham?
Can you hear me?
Now I can hear you. Yes.
So the quick answers to that is there is uneven data in the global analysis of where ESG is, or self-reported ESG is in investing. So for example, there's a Global Sustainable Investment Alliance. They completely miss all of Africa, parts of Central and Eastern Europe and Latin America in their reporting. So it's just a case of we don't know. Because some of that reporting at the landscape and the marketplace level is missing. Secondly, great time for me to plug. We'd like to do a 10-year look back and review on private equity in sub-Saharan Africa, so we can have a hard look at those numbers. And then landing with, in the US, for example, the market, I've most recently had a look at in terms of private equity terms. The numbers are looking like $1 in $3 in some way has ESG self-reported and explicit in the investment process or strategy.
Thank you. I hope that answers your question. That moving on, I'll ask there's another one. Interesting one, especially
just Hyder, just quickly, some of the listed data on ESG as Graham
go ahead.
defined self-reported. If you're looking in the US or even in Europe, it's a 50-odd% share of funds claim some kind of ESG credentials. That's in the mutual fund or ESG listed fund market, so not in the private fund space.
Well, which still gives us a good indication, 50%. That's good to know. Now with the SFDR also coming, so let's hope we see more. So another question is that's especially focused on Africa. Maybe Nicholas, I'll ask you to answer that. What is your experience of ESG policy implementation in Africa? That is, especially in those countries where they do not know about ESG and they do not see the added value. So how do we implement that? Interesting question.
It's a great question. Patchy at best. Is the short answer. And therein lies both the challenge and the opportunity, right? So certainly in our experience, I mean, I can tell you, Hyder, we do an enormous amount of work on the investee side in terms of explaining the benefit, right? Because again, put yourself in the shoes of the typical investee. It may be a small business. There may not be a natural affinity for global capitalism, as it were. And all of a sudden you arrive and you've got your 10-page checklist. And from the business owner's perspective, essentially this is just making my life much more complex, much more difficult. What's in it for me, right? And so, at a high level, clearly there is something in it for them. If you have flows of capital and they're appropriately dispersed, you should have cost of capital coming down, and you should have a more equitable distribution thereof. But certainly we find that there's at this stage a large educational component, and that, by the way, points to another challenge which we haven't really touched on, which could be the subject of a webinar in and of itself, which is the challenge of identification and origination of marketable and bankable opportunities across the continent. So short answer, patchy, but moving in the right direction. But quite frankly, at this point in time, I think we should expect no less. Yeah,
but we do hope that it's 5 years down the line, it will get better, and because it's a growing let's say aspect or sector, so it will grow as we move ahead. Next question is that's more on the implementation side. What are the top 10 most important variables to look at, and how are these best measured? So I'm guessing it will cover all three of the ESOG. Tamar, would you like to take that?
Top 10 is a tricky one. But I would say, even just looking at the IFC sustainability performance standards, we have 8 performance standards, and we want to be looking across labor and working conditions and cultural heritage and risk assessments and the social environmental management systems of organizations, and of course occupational health and safety. So it's a very broad domain that we want to be looking at for each investee, and one is no less important than the other. I would jump on the previous question that was posed to Nicholas about regulation, and policy. It's always just about taking we are looking to adopt us. I mean, if I mentioned the IFC standards, and to adopt a standard that you can hold yourself accountable to, and to try to take the stricter approach. That way you really make sure that you are continuing to engage with the best practices.
Yeah, very true. And maybe to add on the most top 10 variables, I completely agree with Tamar. From personal perspective, at IQEQ, well, we have clients all over the world, so we see that the preference differs in different let's say sectors you are, or in different countries you are in. So that would actually depend on a lot of different factors. There's another question from the audience. Actually, we already covered that in terms of the ESG considerations that plays a role on exit, but there's another question that says, are GPs interested in ESG policies and intentions of potential buyers? So I think that's interesting. So would the GP actually have it with the right intention, or is just to make the LP happy? What's your view, Graham?
Yeah. I think both those things can happen, as I described earlier. And let's be clear, for many investors, and particularly the professionals on this call and our colleagues in investment committees, many of them are still coming to grips with what environment, social governance factors in investment decisions looks like, how that can work, where that data is going to come from. But some of the challenge that you'll need to face is some hard decisions about what you'll stop doing. So, for example, on the outskirts of the Hluhluwe-Umfolozi Game Reserve in KwaZulu-Natal, South Africa, there's a coal mine called Sinclair. It's held by a private equity shop called Capital Works. It's a coal mine 10 kilometers from the gate of a nature reserve, which is protected, and at night you don't want to see any lights, and it has been for centuries because it was the Zulu King's old hunting grounds. Why is a private equity fund investing in coal In 2021, they helped to list it in 2016, fair enough. But in 2021, what private equity fund, however good your ESG reporting policy is, would be investing in thermal coal that's caused community issues, transportation issues, and public health issues in that particular site and wherever that thermal coal is then burned? So there's some part of this ESG conversation that has to have investment committees saying, and we've seen this happen with a lot of LPs, which is flowing through the GPs, to your question, what are we going to stop doing? And of the work that we are going to invest in, how are we going to do that better? So I want to be, and this is one very easy way to clear the clutter between what is greenwashing and what is private equity investing in that.
And ultimately, just to weigh in on that, Hyder, I mean, I think ultimately at root here, there's some trade-offs that are implicit, you know, and if you look at something like coal, you know, if we're going to meet the target of 1.5 degrees, you know, 2/3 of coal reserves currently on somebody's balance sheet have to be left underground. That is going to hurt a lot of, you know, a lot of people are going to be hurt through that outcome, but it has to happen if you want to meet the target. So ultimately on some of these issues, there is a trade-off. And I think we need to be very honest about framing the trade-offs and ensuring they're made appropriately. Those decisions are made and documented appropriately. And I think, you know, there was a question about governments in Africa and where they're weighing in on this and whatever. I think, you know, this isn't a handoff to government. This is the whole ecosystem is responsible. So as a consumer, you're responsible. If you buy something wrapped in plastic, you need to be thoughtful about that. As a pension fund contributor, you also have a responsibility. How is my pension money being invested? I should be asking, you know, the pension fund, what are your policies in this regard? Have you thought about these things? Please let me know, as an investor in this pension fund, how you're managing my interest in this regard. And ultimately, I think, you know, what's quite stark in a way is that some of this agenda is being driven by teenagers in Europe and the US to some extent, because those are the guys who are getting out there and making some of this stuff very visible and are intimidating, frightening politicians into realizing, you know what, you're going to be voted out if you don't step up on these issues. So I think there is a collective responsibility around this for everyone to be engaged and not to be saying, well, what are the rules? Am I compliant with the rules? Should the rules change? Whatever. Actually, we all have a responsibility to say, you know, what am I doing with this bit of plastic? What am I doing with this? And where is my investment dollar going and how is it being looked after?
Fair point. Guys, I mean, I know we could keep on talking a lot about ESG, but I'm conscious of time. So there's 2 minutes left. So I'll just maybe give my understanding of my summary of things, and then we'll wrap it up. So everybody, thank you for your time. My personal opinion of my key takeaway of today is I've noted 3 things. One, we know that ESG is becoming very important and is here to stay. So whether it's GPs, whether it's LPs, or the investee companies, it's in our best interest to get started and to move ahead on this. But what I took away mostly is that there shouldn't be any blah blah. Like Graham said, and even if you're a small GP, you're a small fund manager, size doesn't matter. Well, no pun intended there, but that's where we should go. And like Paul mentioned just now, it's not just about the GP. It could start from us personally when we're putting money in our pension fund. That's I didn't realize it, so it's a very good point, Paul. I will go and speak to my HR and to make sure that we speak to my pension fund as well. On that note, audience, thank you very much. I apologize I couldn't take all the questions, but thank you for your time. Big thank you to the panelists. It was great speaking to you. And of course, Africa Global Funds, thank you so much. And we look forward to maybe another session. Thank you so much. Bye, everyone.
Thank you.
Thank you, everybody.
Bye. Thank you.
Stay safe.
Bye.
Cheers.